for now, with that being said, I would like to kickstart this 12th edition of the RWS by welcoming on stage a friend and someone who's been opening up the event for the last few years. Please welcome Jamie Lanes from AirDNA.
Thank you, Antonio.
This is yours.
Yep.
And see you in a bit.
See you in a bit. Well, I'll be a little bit smarter in about 30 minutes. So thank you all again for having me come to this conference. It's absolutely one of my favorite events of the year. In beautiful Rome. So a lot of us were just in Las Vegas for another conference. Man, coming from Vegas to Rome, like this is incredible. Love this city and love the history, the real history that we see around. So I've got a lot of data to share. We're going to do a run through of the European economy, supply trends, what's happening in performance across both US, Europe, and globally. And then we'll take a look at what's ahead in terms of the outlook. Anyone coming back this winter for the Olympics? No one. Man. Exciting to have the Winter Olympics back in Italy. All right, so the European economy. Can I get a sense, who's feeling good about the European economy right now? One. No one? Two? Three? All right. Man, I was really hoping for some more hands. I asked the same questions at past few conferences going around the United States, and I got the exact same answer. No one is feeling good about the overall economy. Now I'm going to show you this chart. So this is unemployment, and I've called out the EU, I've called out Italy. I could have thrown the US on here. We're at record low unemployment. Essentially, everyone has a job that wants a job. Why aren't you guys feeling good about the economy? Like, I mean, this is amazing how much we're seeing full employment really across the world. And when you look at the impact of, as an economist, and I've been doing this now for 15 years, the two measures I look to the sense of if people will be traveling, it's do they have jobs, and are their real incomes going up? What are they making? Subtract out inflation. And what we see across Europe is real incomes are going up. People have more spending power than ever before. And consumer spending is actually doing really well. So all these factors is actually, it's looking pretty good for the overall European economy. And then inflation, because inflation has been one of the biggest concerns over the past 5 years coming out of COVID. And to be fair, the European economy has been weak. We almost went into recession in 2023. And what the ECB, the European Central Bank, did was they started cutting rates. And they were able to cut rates because going back to 2023, inflation got back down to target. So inflation was no longer a concern. They could cut rates in the economy to really support growth, support investment in the economy, and we begin to see that. And we see that low inflation in both the US, in Italy, in the European Union. US, we're not quite the target. I'm starting to see some reversion back up in terms of inflation trends, but overall, this is a relatively healthy picture for inflation. And when we go and look at GDP growth, because this is essentially how the economy is growing, you look at the Eurozone, we're growing at about 1%. That's roughly half that of the US. But when we look at 2025 and look at 2026, so we see this bump up here in 2025. So that is a lot of front loading. So if you haven't heard, the US is doing this tariff thing. It's causing all sorts of global, that was a joke, global turmoil. But what it meant was a whole lot of countries, including the US, started front-loading purchases for goods because they wanted to get ahead of tariffs. And what that did was that made economic growth look really strong in the first and second quarters. And now we're expecting the second half of the year to look weaker. and we're going to see some of the impact of that in 2026 as well. But then in 2027, we do expect things to reaccelerate. So across the European economy, we're essentially in this slow growth environment, but we do expect it to continue expanding. And when we look at the US, we're going to see pretty slow growth for 2025 and 2026. And then we expect to get through a lot of these tariff impacts and go into 2027 with stronger growth. So and I'm optimistic. Who knows what's going to happen? We're still very high risk of recession across the global economy. We have no idea what's going to happen on tariffs. Things are looking good today. It looks like we've got sort of a China agreement. It looks like we've got a set 15% sort of tariff across the EU to the US. But who knows how that could change? And this heightened uncertainty has caused, and you'll see it as a theme throughout the presentation, absolutely some pullback in spending, especially in those consumers on the lower income tiers. So those traveling on private jets, going to some of the best villas around the world, they're doing fine. But if you think about where inflation has impacted people, it's those at the lower income where an increase of 3 or 4% of good cost, when their income's maybe only going up 2 to 3%, that absolutely impacts their ability to spend, and they want to save. They don't know whether they're going to maintain their job, and they do, and we have seen some pullback. So I'm going to start with supply, then we'll talk about demand, because supply is actually one of the most interesting things I see across both the US and Europe. And I'm going to touch on this trend that we see, and we hear it from the major OTAs. So right out front, we've got Airbnb, Booking, and Vrbo. And listening to their executives talk, they're all talking about quality versus quantity. They want to see quality listings, and they're less focused on the quantity coming in and getting everything, all the listings that they can possibly get onto their platforms. You hear, and Airbnb's removed 500,000 listings on their platform because they're underperforming. Vrbo's done over 100,000. This is a trend. But now starting to look at overall supply growth. So I've got both the US and Europe here, and we see entirely different trends coming out of COVID. US recovered demand quickly. That brought supply back quickly. Europe recovered more slowly. But now we've all sort of converged around the same spot. And that is very low supply growth. And for Europe, this is a new thing this summer of low supply growth. This time last year, I was talking about supply growth of about 15%. The year before, about 20%. We were seeing massive influx of new supply into the European short-term rental market. We were seeing the same thing in the US just a year earlier in terms of the overall trend. But now both for the US and Europe, we're seeing supply growth of about 2%. 2% supply growth is maintainable. 2% supply growth is something that we can continue to grow occupancy into. 2% supply growth gives us the ability to have pricing power, to raise rates, to add profitability to our business. As an operator, I like 2% supply growth. The OTAs out there, maybe I don't like 2% supply growth. That's really hard, and to get a tech multiple of being a high growth business when in your major market supply is only growing by 2%. And when we look across a lot of the major European countries, and I've sort of pulled out 10 to give you guys a sense of the wide range of growth that we see across the European market, we see a few different trends. And one really strong growth in Germany, Portugal, these markets that are seeing actually pretty significant investment coming into them. German economy isn't super strong, but we're actually seeing really strong both domestic and international inbound demand. And then these three markets over on the left. Spain just recently, we've seen the enforcement of new regulation. We saw about 60,000 listings being removed across the Spanish market. We've seen the impact of regulation across Italy and Croatia. This is something to watch going into 2026, and it's going to be another theme throughout the presentation of these markets. And maybe we'll talk throughout about the difference we're seeing in 2025 between France and Spain, both markets with weak supply, one being dominated by the impact of the Olympics on a year-over-year, and the other being dominated by regulation that's coming in. And one, in Spain, we're going to see pretty strong unit economics, i.e. occupancy growth, rate growth, because the market's being artificially constrained by regulation. In France, seeing the impact of, and we had one of the biggest events of the world last summer. We saw a lot of supply come in, and now we see supply pulling back in certain markets, and you can actually see this. So this is 50 of the largest European markets. Also, my last slide, I'm going to have a QR code where you can get this presentation. You don't have to necessarily be taking photos. If you want to, go for it. But all these slides will be available for you to be able to download. But you see the markets with the biggest declines in oversupply. It's Paris, it's Marseille, two markets that were central to the Olympics. And then growth. Rome here. Very strong growth in overall supply. Prague, Bucharest, Barcelona is actually seeing growth off of a small base, though, getting ready for pretty significant regulation coming in. But wide disparity. And 50% of these top 50 markets seeing declines, 50% seeing growth. So it's really a very market-specific trend in terms of oversupply. And this is the place I start to get a sense of what the trends are happening in your local area. And then looking across the channel mix, this is supply in terms of what the overall European market looks like among the major OTAs. What's interesting, though, in terms of overall bookings, we actually see more overall demand coming through booking than we do see through Airbnb, and significantly lower demand coming through Vrbo. So supply may be a little bit misleading in terms of the impact of these OTAs on the overall market, but this does get a sense of the market share in terms of overall listings as of this past month. All right, I talked about quality over quantity, and wanted to give it just a quick screenshot of what we see across, and I'm sure you guys are looking at this on a day-to-day basis, but something I want to call out, because this is relatively new within the past couple of years, of this focus on really calling out quality in the listings. So we look at here at Airbnb, we've got guest favorites. We got guest favorites plus the badge. We look at Vrbo, we've got Premier Host. We have this new, I don't even think they've launched it yet, by Love by Guests, and that's the equivalent of Airbnb's top 1% or top 10% badges. And these badges are so important now for search, for ranking, which ones are showing top. And when we look at these badges, they're getting more and more harder to get. So Superhost, what Airbnb had for a decade, 52% of listings now have Superhost badge. If over half the listings have a badge, is it really that special? But then you look at guest favorites, it's only 43% of listings. And then these top 10% badges, it's actually 13%. Notice that they do call out in top 10%, but it's actually top 13%. And then on the bottom 10%, anyone see that badge showing up? Bottom 10% is about 6% of listings that have the bottom 10% badge. But what's scary now as a professional operator is that top 1% badge of listings, only 1% of those listings go to professional operators. It's essentially impossible for a professional operator to get one of those top 10% badges, to get one of the top 5 or top 10%. Essentially, if you're an operator with more than 21 listings, you're not getting one of these badges. They are giving you the bottom 10% badge, though 43% of those bottom 10% badges are for professional operators. So it makes it more difficult to get to the top in terms of search. It makes it more difficult to drive incremental revenue into these properties. And that is one of the sort of trends that we're seeing called out is the operating disparity between properties that are generating 5-star reviews across Airbnb, Vrbo, and Booking, and those that are generating more average reviews, which is about a 4.7. That's a 14% increase in RevPAR when controlling for size, amenities, location, things like that. And then we also see a pretty significant disparity across churn. So if you are one of those underperforming properties, if you're generating below a 4.7 review score, we're seeing almost double the rate of churn for your property. So your owners are noticing, they're seeing it in terms of the returns, they think they can get higher returns elsewhere, and we're absolutely seeing that disparity show up in the churn rates. So when we look at review scores, and I've used this chart the past 3 years, and I think every time I come, I'm going to show this chart because I want to give you guys a sense of how it's changing. And are we improving as an industry? Are we getting worse? And across the industry still, the biggest gaps are in terms of communication and value. But I would say in terms of the biggest gains, we also see that in communication and value. And if you look across this vendor hall, there's probably going to be 5 or 6 different companies that are bringing AI tools in. And we actually see the overall biggest gain, the number one gain that we've seen is in these large operator businesses, is coming from communication. That it's hard to scale great communication, but the tools that the vendors in this hall are doing are absolutely allowing better communication with guests. And we see that. It's clear in the data. It was one of my big concerns that actually AI guest communication was going to cause a decrease in these metrics. We're seeing the opposite, actually pretty significant gains. And then when we look at how these have trended, so overall property managers, we're now at a 4.64, individual hosts at a 4.81. This gap is closing. It got to a pretty significant point in 2023. I think this is what the major OTAs were seeing, is like, this isn't sustainable. We're seeing scores go down for the professional operators. We've got to focus on quality and making sure guests are having a great stay if we're going to keep them within the ecosystem. So now, that's a good sense on supply, driving into demand. And overall in Europe, we did see record high demands this year. I sort of break it out in 2 different ways. This is based on the stay date. We see the peak in the summer, and then we also have it by the booking date. We see the peak in bookings in the first and second quarter, and then we see bookings sort of dissipate throughout. But you do see the gap between last year in light blue and this year in dark blue. It's getting smaller. So we are seeing, as supply growth has slowed, demand growth has also slowed. This was a big question heading in this year in terms of supporting overall demand growth in Europe. Across Europe, the biggest driver of inbound demand is from Americans traveling to Europe. So getting a sense, and I have this chart stopping at this time last year, and I asked the same question last year. Do we think Americans kept spending this year? Raise your hand. Traveling more to Europe this year? Was it steady? Raise your hand. Essentially flat. And who thought it went down this year? So we had about a third. And for a third consecutive year, we saw it way up. So we saw outbound spending by Americans to Europe up 8% year over year. We saw inbound spending to the US down 3% year over year. So Americans were traveling overseas. No one was coming to the US this year. And when we look at these compared to 2019, outbound spending by Americans is up almost 50%. This is really driving some of this really strong demand growth that we see across Europe. And we look at, as US operators, inbound spending to the US is still down 1% compared to 2019. And this is absolutely impacting quite a few markets across the States. So when we look at the sort of breakout of European travel, so we break it out between domestic travel, so Europeans traveling within Europe, and then international, so anywhere outside of Europe traveling into Europe. And really the past couple years, it's been driven by domestic demand growth. International, yes, more Americans were traveling, but overall, we only saw about 1% overall demand growth from international guests. So this is an area that we can continue to improve on. When we look at overall demand index back to 2019 levels, most of the demand growth is still happening outside of those top 50 cities that I called out earlier. though this year, 2025, was the first year that we recovered demand back to 2019 levels. So overall demand is up 28% compared to 2019. In the major cities, it's flat. So the growth has been and continues to be in the mountain markets, in the beach markets, in the more rural areas throughout Europe that are driving incremental demand. This is where people want to travel to. And I think most importantly, this is where short-term rentals, this is where vacation rentals are really winning in terms of guest preference compared to hotels. So the larger the listing, the stronger the demand, the more that vacation rentals are differentiating themselves away from hotels, the stronger we see overall performance. And then also, this isn't just unique to Europe, but we see it very clearly, is that the strongest growth has been in the shoulder seasons. So I was walking around Rome yesterday. It felt like in the middle of summer, and tourists were everywhere. It looked strong. And that's a trend that we see throughout most European cities and even the beach and mountain markets, that the season is expanding. The times when guests are maybe looking to avoid some of the summer crowds and pushes out. And then also, and this can't be forgotten, is the American population is aging. The boomers are getting into retirement age, and they are now not sort of tied to that summer travel calendar. They can travel really whenever they want, and we see that expanding the periods when they're willing and able to travel, and that could be a huge trend pushing over the next decade. When we look at overall performance trends, I said, as supply growth has slowed, we have seen occupancy sort of gain because of it. This summer, we saw overall occupancy up 1.9% across Europe. That is an overall European trend. It does vary. It varies by the country you're in. It varies by the price tier that you're in. But overall, I look at this dichotomy between the US and Europe. Overall, occupancy in Europe, I said, grew 1.9. For luxury properties, it was up 2.9% this summer. Luxury in the US was flat. When we look at budget properties, yes, it was slower growth in Europe, only 1.2%, but compare that to US performance this past summer, it was down 2%. So this is a very strong overall European market in terms of occupancy gains. It's why I was hoping to see more hands going up and record low unemployment. We're seeing occupancy gains across Europe. We're seeing more and more travelers coming into the European continent. Overall, it's looking relatively healthy. And then sort of calling out some of the top 20 countries in Europe, what we're seeing in terms of supply growth, demand growth, occupancy change. You see these orange lines broadly positive across Europe this summer. We do see some declines, Finland, Hungary, Belgium, but generally up. And then when we look at overall demand growth, so yes, and some weakness in some of the larger European countries like Spain, Italy, France, Greece. But when we look at some of the Nordics, Norway, Poland, Belgium, Sweden, and we've talked about this in quite a few posts and in the media, and of sort of climate tourism, and some of the strongest growth, especially in the summer months, pushing to some of the northern countries as people looking to escape some of the heat in some of the southern countries. And then when we look at some of the major cities, regulation pressures absolutely showing up in terms of both pulling down overall listing counts, impacting overall demand, and ultimately impacting overall occupancy as well. So as I called out, Paris, Marseille, seeing overall impacts of the Olympics, and a lot of supply coming in, now a lot of supply coming out a year later. But this has been overall positive for occupancy in this market, though because of the year-over-year comps against the Olympics, rates are generally down. And this gives a sense of what we're seeing across overall rates. So at AirDNA, we track rates in two different ways. One is guest paid. And guest paid rates can be very volatile because of this changing supply mix. And then what we also do is this repeat rent index, which tracks essentially the same listings year after year after year and how they're actually changing their rates on a same-store basis. And this is where we see and the average daily rate, that guest paid rate, can be much more volatile as supply overall changes. But we do see similar trends across the different countries, rates falling in France, and then with the regulatory pressure in Spain, we actually see pretty strong overall supply growth. And with the average daily rate going up significantly higher, a lot of the listings being pulled out are some of the lower priced units across Spain. So that is pushing overall rate up because the ones left are some of the higher rated properties. Now going to the outlook. We've got 5 minutes left to talk about what we're seeing this winter and heading into next year. And you see my emoji. It's looking pretty good. So that is always a worry, and we have a strong summer. Is that going to continue out into the winter? And this is a lot of wavy lines, but we spend a lot of time and have put a lot of effort in the past couple of years of getting really good pacing data. So tracking your market, tracking your country, what is on the books as of today? How does that compare as of the same time last year? And that's what these two bars, sort of the green and purple bars, show. So looking at October this year, we had about 33 million nights sold as of, I pulled these slides as of 2 weeks ago. And then what did we have of the same time last year? It was about 32 million. We saw about 5% growth in demand pacing for October. As we look in November, it's essentially flat. We didn't expect any demand growth, or at least it wasn't pacing up for November this year. But now as we look into the key winter months, December, January, February, we're seeing average overall pacing for those winter months up about 10%. So that's 10% more demand on the books for winter as of today than we saw as I was standing here last year. So that's very good as we think about the indication consumers are sort of telling us about what they're willing and able to book. Though as we look into next spring and summer, this is where we see a bit more volatility. We do have some issue on calendar shift here, but overall, we're seeing next year, so spring and summer, pacing about flat. So with overall supply growth up about 2%, demand pacing flat going into next year, that does show us that occupancy is pacing slightly down heading into next spring and summer, which this is still really early. There's, 2 or 3 million nights booked. Like, this is like 90% of what will eventually be booked. There's still a lot of bookings to happen. But just a caution of heading into next year, it is looking a little bit weak as we head into next summer, though this winter is looking strong. When we look at pacing now, and this aggregates the data October through February, we're seeing the same trend of the upper end of the income spectrum. The upper end listings pacing is very strong. So across every single month, October, November, January, February, luxury in dark blue pacing very strong in terms of overall demand. When we look at the budget and economy sectors looking significantly weaker. The past 2 years, I sort of called out big travel events that were happening. We went from Taylor Swift, we went to Oasis, we got to hear Tebow sing Oasis to us, or was that Taylor? It was Taylor Swift. That was amazing. I'm hoping we're going to get a new version of that this year. Yeah. But this year, I wanted to call out what we're seeing around the Olympics. This will be a major demand driver for both Italy and all of Europe as people head out for the games. Among some of the major event venues up in the mountains, we are seeing strong pacing now for 2026 compared to last year. So this is going to drive significant demand in the host market. So Milan, we are seeing 700% demand growth. So very strong overall listings. This gives a call out in our new pacing tool of how you can see what that demand is. So overall, there's about 700,000 nights already booked during the Winter Olympic period, so between February 3rd to mid-February. And this is going to be a major demand driver in both Milan, and I suspect we'll see it throughout Europe as both Americans and people really throughout the world come for the games and look not to just travel for the games, but make a longer stay out of it. So this could be a real demand driver throughout the Alps as people are getting out a lot, and it's easier to fly into Venice than it is to Milan to get to a lot of the venues. There's going to be a lot of people staying in Switzerland and France and traveling in, so we see this could be an absolute boom across the Alps in terms of overall demand. And then I promised that I would give everyone this QR code. I'll stand out. Happy to discuss the trends that we're seeing across your market at the AirDNA booth over on to your left. And I really appreciate everyone joining for this conference again and listening to the presentation. Thank you.
Thank you, Jamie.